The secret deal that made money a pure illusion wasn't secret in the sense of hidden documents. It was secret in its implications. Few understood what the closing of the gold window truly meant. It meant money would no longer be something you could redeem. It would be something you believe in. And belief systems are powerful, until they're questioned. The world has operated on fiat currency for over 5 decades. It has produced growth, innovation, and prosperity. But it has also produced unprecedented debt, asset bubbles, and repeated crises. The question isn't whether fiat money works. It clearly does, for now. The real question is, how long can an economy built entirely on confidence sustain expanding promises without tangible backing? Because once money becomes pure belief, the strongest currency isn't gold. It's trust. And trust can change faster than any exchange rate. Money became policy-driven, not scarcity-driven. Once gold convertibility ended, money supply depended on political and central bank decisions, not physical limits. 2. Debt expansion accelerated without hard constraints. Fiat currency made large-scale borrowing easier and more sustainable in the short term, but it removed automatic discipline. 3. Stability now depends on trust. Without gold backing, the entire monetary system functions on confidence in institutions. Trust replaced metal. And trust is harder to measure. Today, money is mostly digital. Bank balances. Bond markets. Electronic transfers. Very little physical cash exists compared to total financial assets. Yet this entire structure rests on collective belief that currencies will hold value. Unlike gold, fiat money cannot be redeemed for a physical asset. Its value is derived from government taxation power, economic productivity, market confidence. As long as people accept it, it works. But if trust erodes, there is no metal backing to fall back on. That is the defining shift that began in 1971. The temporary suspension permanently transformed money into a confidence-based system. After decades of low inflation, many believed fiat management had been mastered. Then came 2020. Massive stimulus programs. Trillions in new spending. Aggressive money creation. Initially, markets soared. But by 2022, inflation surged globally. The same system that allowed rapid emergency response also amplified price instability. Central banks raised interest rates sharply to fight inflation. But higher rates exposed another vulnerability. Debt servicing costs exploded. Governments found themselves trapped between inflation and insolvency. The fiat system revealed its paradox. The flexibility that prevents collapse also creates long-term fragility. A fiat system works, as long as confidence remains intact. But confidence is fragile. The 2008 financial crisis revealed how quickly trust can evaporate. Banks stopped lending. Credit markets froze. Asset prices collapsed. Central banks responded with quantitative easing, creating money electronically to buy government bonds and financial assets. This would have been impossible under a strict gold standard. The system survived. But something changed. Markets began expecting intervention. Every downturn was met with liquidity injections. Every crisis expanded central bank balance sheets. Every shock increased long-term debt levels. The illusion of control deepened. Before 1971, U.S. federal debt was relatively restrained compared to GDP. After 1971, the chart changed direction permanently. Debt began rising steadily. Then rapidly. Then exponentially. This wasn't just an American phenomenon. Because the dollar remained the world's reserve currency, other nations followed similar fiat models. Global debt surged into the trillions. Then tens of trillions. Now hundreds of trillions. Without gold anchoring currency supply, debt no longer required equivalent reserves. Money could be created digitally. Government bonds could be purchased by central banks. Liquidity could be injected during crises. The system became self-reinforcing. More debt required more liquidity. More liquidity required more trust. Trust became the new gold. Once money was untethered from gold, governments gained unprecedented flexibility. They could issue currency without worrying about depleting reserves. Central banks could expand money supply to stimulate growth. Interest rates became the primary tool of control. Debt markets flourished. The 1970s saw high inflation, a direct result of sudden monetary expansion. But instead of returning to gold, policymakers doubled down on fiat management. Over the next decades, credit markets expanded massively. Derivatives multiplied financial leverage. Government deficits became normalized. The removal of gold did something subtle but profound. It removed an external constraint on political spending. Now the only limit was inflation, and inflation could be managed, delayed, or redistributed. On August 15, 1971, President Richard Nixon addressed the nation. He announced that the United States would, temporarily, suspend the convertibility of the dollar into gold. This became known as the Nixon shock. Temporary. That word mattered. But the gold window never reopened. The world had crossed a line. Money was no longer tied to a scarce physical asset. It was backed by government decree and collective confidence. The discipline imposed by gold vanished overnight. And with it, the final barrier limiting debt expansion. But systems built on restraint rarely survive political pressure. During the 1960s, the United States dramatically increased spending. The Vietnam War. Expanding social programs. Growing global commitments. At the same time, other countries accumulated large reserves of US dollars. Here's the problem. There were now far more dollars circulating globally than the US had gold to redeem. Foreign governments began to notice. France, under President Charles de Gaulle, openly questioned whether the US could honor its gold commitments. Nations began requesting gold in exchange for dollars. Gold reserves began draining. The illusion was under pressure. For thousands of years, money had intrinsic value. Gold and silver weren't just symbols, they were the money itself. You couldn't print more gold. You had to mine it. Extract it. Work for it. That scarcity created discipline. Governments could not easily overspend because currency supply was limited by physical reserves. In 1944, near the end of World War II, global leaders gathered in New Hampshire at the Bretton Woods Conference. The goal was simple: rebuild a shattered global economy. The agreement created a new monetary order. The US dollar would be backed by gold. Other currencies would be pegged to the dollar. Foreign governments could exchange dollars for gold at $35 per ounce. It was a compromise between flexibility and discipline. The dollar became as good as gold. And for a while, it worked.